Hi everyone. In this lecture, I'm finally going to give you the formula for UND and the meaning of it. This is something that I've been dodging since lecture 1, part 1, if I'm not wrong. Okay, but now is the time to let you know it. But before that, I would like to make 2 points to set a background for it. The first one, if you remember in the very first introductory lecture, I said that there are 5 factors which influence the price of an option. The first one being the stock price, the second, the strike price, the third, time to maturity, fourth, the risk-free rate, and the fifth one, volatility. Okay. The price of an option is nothing but the value of the option, which refers to the premium that holder should pay to the writer. Okay. Now think of a single period binomial model, the example that we took. Okay. We have taken just one example right through all the 3 methods. So let's continue talking about that just for this lecture. Okay. If you remember, if the stock price that we considered was 50, the current stock price was 50. Okay. So the first factor was taken in our binomial model too. The second factor is the strike price, which in our example was 48. So this was also considered in our binomial model. The third one was the time to maturity, which in our case was 6 months, or yeah, it was 6 months. So even the time to maturity was factored when we were calculating the value of the option. The fourth one was the risk-free rate, which was 5% per annum, which we considered as 2.5% for 6 months. And this was also taken into account when we were discounting, right? So this was also considered when we calculated the price of an option. The last one is volatility. Okay. In fact, in the given data set, I did not give you what volatility was, right? Does that mean that we actually did not consider volatility in our single period binomial model at all? If we did not consider, then the single period binomial model is actually not the correct method, because volatility, like we saw, plays a very, very important role in calculating the value of a call option or the value of a put option. Okay. So if volatility is one of the most important factors, and if you have worked on a model which does not capture volatility, then it is definitely not a good model, right? Okay, so the answer is actually volatility was considered, but it was considered implicitly without your knowing. Okay, volatility was actually considered through U and D. What we assumed as 1.1 and 0.9, volatility was actually built in within those assumptions. Okay, so we assumed a value of 1.1 for U and 0.9 for D. Instead, let's assume hypothetically, if we would have assumed 1.2 and 0.8 instead of 1.1 and 0.9, if we assumed U to be equal to 1.2 and D to be equal to 0.8, then the share price on the upside would have been 1.2 into 50. Okay, earlier it was 55, which was nothing but 50 into 1.1. Now it would have been 50 into 1.2. So the upside share price would have been 60. Okay, and the downside share price would have been 50 into 0.8, which is 40. Okay, so if you actually imagine, okay, the example that I'm first writing, the example that we took. Okay, so we had taken 50 as the current share price, and we said it could be 55 or it could be 45. Okay, this we multiplied by 50 into 0.1. And this we multiplied by 50 into 0.9. Okay. Alternatively, had we assumed 1.2 and 0.8, it would have been 50 could go up to 60, or it could fall down to 40. Okay. I intentionally drew this node a little higher than 55 to signify that, you know, there is a greater upside. And over here on the downside as well, I drew 40 less than 45 because to signify that there is a greater downside. Okay. So if there is a share which could go up to 60 or could fall down to 40, obviously this is more volatile, right? This is more volatile. Agreed? because the spread out is much wider. Okay, there is a share which is trading at 50 today. It could either increase by 20% or it could fall by 20%. Whereas in this case, the share could increase either by 10% or it could fall by 10%. Right? Volatility is nothing but the variation in the return, right? And the variation in the return is much higher in the second case, right? So indirectly, U and D are actually capturing the volatility. So which means that even in the single period binomial model, volatility was taken into consideration. Okay, without volatility, there cannot be an option valuation model because volatility is one of the core components. Okay, so first thing is, please have the background in your head that volatility was actually captured in the single period binomial model also through U and D. Okay, so when I'm breaking U and D down, you will realize that volatility is one of the components of U and D. All right. Okay, so this was basically an extract that I showed you as part of the introductory lecture. Okay, let's just quickly go through that as well. So for call and put options, we said options are all about volatility. If a share is more volatile, it basically means that the share price is fluctuating widely. Okay, volatility does not mean that you have a greater downside. Okay, it just means that your returns are fluctuating. Okay, if your returns are very close to each other, then it basically means that the volatility is very less or the share price movement is very less. If your returns are wide, like, you can either have a return of plus 20% or minus 20%. That means that the share price is actually more volatile. Okay, it could go up massively or it could come down massively. Okay, we said that when there is a higher volatility, the possibility of an option being exercised is higher, and hence it commands a higher premium, because if greater the possibility of an option getting exercised, obviously you like that call option more, right? So that option is going to have a higher premium. Okay, and then we took an example with a strike price of 50, and I gave you that there are two possible paths for it. Okay, one path is the share price could go up from 50 to either 70 or to 30. And the second possible path is the share price from 50 can go up either to 51 or 49. Okay, if I quickly just plot this here. So what we said was the first path number one, is that the share price today is 50. It can go up either to 70 or it can come down to 30. Okay, the second possible path is that the share price today can go up to 51 or can fall to 49. Okay, if you realize, this is a more volatile path. Okay, the first path is more volatile because the share price is moving rapidly. The share could either increase by $20 or it could fall by $20. Whereas over here, the share can only increase by $1 or it can fall by $1. Okay, and if you realize, I actually gave an example over here in factors impacting the price of an option. The example that I gave was actually that of a binomial model. Okay, back then I did not introduce what a binomial model was, but the path that I've given was actually that of a binomial model, right? I mean, I've clearly specified that the share could take only two possible values. Okay, but these two are different paths. Okay, I mean, the share could either follow path one or it could follow path two, and within path one it can take two prices, either 70 or 30, and within path two it could again take two prices, 51 or 49. Okay, now if you as an option holder, a call option holder, if you were asked to select which possible path would you prefer, okay, you have the right, I'm just giving you hypothetically, which one would you wish for rather? Okay, would you wish for the share price to follow path one, or would you wish for the share price to follow path two? Okay, but remember, even if you choose path one, there's a possibility that you might get no payoff at the bottom side. Okay, like let us first write the value of the call option. Value of a call option meaning nothing but the payoff, right? So let's assume an at the money option where the strike price is 50. Okay, so the payoff at the upper node for this option would be 20, and the payoff at the bottom node would actually be 0, right? Because at the upper node it is 20, because 70 minus the strike price of 50 is $20. Over here, in the second path, the payoff of the option could be either 1 or 0. Okay, 1 being 51 minus 50. Okay, so it could be either 20 or it could be 1. Okay, now you as an option holder, which path would you prefer? Okay, which path do you wish for? Okay, remember, even if you choose path 1, there is a possibility that you will get 0 as a payoff. Even if you choose path 2, there's a possibility that you get 0. Okay, so that, it does not mean that if you choose path 1, you're going to have a certain payoff. Absolutely not. You could have a payoff of either 20 or you could have a payoff of 0. But in path 2, you could have a payoff of 1 or 0. Which path would you choose for? Okay, if you need, you can actually take a pause at this point and think of what answer you would give. Okay, the path that you would actually wish for is path 1. The reason being, you have a higher possibility of payoff at the upper node. Okay, the share price is volatile, agreed. Okay, but you as an option holder, you do not suffer when the share price crashes. Okay, because for you, the maximum payoff is actually, I mean, the worst case payoff is actually 0, right? Even if the share price crashes by $1 from 50 to 49, or whether the share price crashes from 50 to 30, your payoff is going to be the same. It is 0, right? Okay, but if your share price increases by $20, your payoff is 20 versus your payoff being just $1 when the share price increases by 1. Okay, so if you actually imagine, if I tell you that the share price can increase or decrease by $20 in path 1, and it can increase by $1 and decrease by $1 in path 2, you are not going to be concerned with the decrease because you're not suffering the downside. Okay, for you on the downside, the worst case payoff is actually 0. Okay, but you have a chance to enjoy the upside. Okay, so therefore you would always prefer, as an option holder, an option holder will always prefer volatility, a more volatile stock. Okay, so if you actually, even in the real world, if you see, in cases where for instance, in the COVID period in March, where the stock prices were very volatile, they were either crashing or increasing rapidly, the option premiums were at sky high. Okay, therefore you would always, as an option holder, pay more money or pay more premium when the payoff, of course, if the payoff is higher at $20, when you discount the payoff, the premium that you have to pay today will also be higher. Absolutely no doubt. Okay, because higher payoff, imagine the risk neutral method, higher payoff is going to be discounted, so the current value will also be higher. Say, this $20 might, have a value of, say, 10 as today. This will be the premium, right? This will be the premium, whereas over here, premium would be, say, 0.3 or something. Okay, so a less volatile stock will have a lower premium. A more volatile stock will have a higher premium. All right, so obviously, this higher benefit is coming with a cost, and that cost is nothing but the premium that you have to pay today, that you as an option holder will have to pay today to the writer. Okay, so please don't think that this payoff is basically a free meal to you. Okay, the world does not work like that. If you expect a higher payoff, the value of the stock or the value of an option is going to be higher. All right, so the first thing is, you as an option holder will always prefer a higher more volatility. Okay, as an option writer, he would exactly prefer otherwise. He will prefer a low volatility, because for him, this 20 is actually a cash outflow and this 1 is a cash outflow. Okay, he will prefer having a lower cash outflow, and that is the reason he will choose path 2. But of course, that lower cash outflow means he's going to receive lesser premium today. Okay, he's going to receive only 0.3 today. Whereas in case of first situation, if it was a higher volatile stock, he would have received $10 as premium today. Okay, now, so obviously, if you think that higher premium, more volatility comes with a stock, comes with a cost, what you would generally prefer is, you want the volatility to, you as an option holder will want the volatility to increase after you buy the option. Okay, so what you want is, when you are buying the option, you wish that the volatility is less. Okay, after you buy the option, you want that some event happens such that the volatility spikes. Okay, for instance, if there is an RBI meet or anything of that sort, the volatility of goes up, right? Okay, so before buying an option, you want the volatility to be less. After buying the option, you wish that there is some event such that the volatility goes up. And when the volatility goes up, after you have bought, the premium goes up. Okay, you have bought at a lower price and now the premium is higher and you can sell and exit your position. Okay, so as a writer, when he's entering into an option contract, he wants the volatility initially to be higher. After that, he wants some event to happen such that the volatility cools down. Okay, which means when he was entering into the option contract, he wants a volatility of say 20%. After he enters into the option contract, he wants some event to happen such that the volatility cools down from 20 to say 12% or something. Okay, then what happens is he has basically sold an option at higher value. Okay, because higher volatility initially means that he would have received a higher premium. Okay, now if the volatility cools down, the premium will actually reduce. Okay, so he has sold it. He can square off the position. Squaring off the position meaning he can buy the call option now at a lower price. Okay, so it means that he would have sold it at a higher price, buying it now at a lower price, therefore making a profit. Okay, so that is basically the background. An option buyer prefers more volatility. An option seller prefers less volatility. Okay, so we basically wish for path one as an option holder. Okay, this is completely from the viewpoint of an option holder, but this higher volatility comes with a cost, and that cost is nothing but higher premium. Okay, it is very easy to imagine because your payoff over here could be $20, over here it could be $1. Now that you have learned risk neutral method, the today's value of an option is nothing but the present value of the expected payoff, right? Expected payoff will actually be somewhere between 0 and 20, right? Because over here the expected payoff will be somewhere between 0 and 20, and the present value of that is basically, I assume, to be $10. Okay, it could be some 8 or something like that. Okay, so it comes with a higher cost, whereas in this case the expected payoff will be between 0 and 1, say 0.7 or something, and that the present value of 0.7 will, I have assumed, to be 0.3. Okay, of course, these are just rough numbers, please don't go by them. Okay, so an option buyer always prefers high volatility, but higher volatility comes with a higher cost. Okay, therefore, what generally option buyers wish for is they want the volatility to be less when they enter into the option, but they want some event to occur so that the option volatility goes up after that, such that the option price also goes up when volatility goes up. Okay, this wish of option buyer and option seller, I did not write it, but when I upload the PPT, I'll just add it at the bottom, what an option buyer wishes for and what an option seller wishes for. Okay. Now, this was one concept that I actually wanted to tell you, that volatility is actually captured in U and D. Okay. Now, the second concept that I actually wanted to, the second topic that I wanted to create a background about was about standard deviation and variance. Okay, so firstly, let's say I have a stock whose mean is equal to 10% per annum. Okay, the mean is 10% per annum. If now I ask you what is the mean for 6 months, okay, the mean is 10% per annum. I am asking you to find out the mean return for 6 months. Okay, the answer will be mean for 6 months will be equal to 5%. What I've basically done is I've written 10% into 0.5. 0.5 is nothing but 6 by 12, right? Okay. Now, if I say hypothetically that standard deviation is equal to, let's say, 24% per annum. Okay. And now I'm asking you to calculate the standard deviation for 3 months. Okay. The answer that you might tell me is 24 into 0.25. 0.25 because 0.25 is 3 by 12. 24 into 0.25 is equal to 6% per annum, right? This would be your first feeling. Okay, this is wrong. Okay, because over here mean is actually proportional to time. When I say proportional to time, it basically means that when time increases, you can basically multiply that increase in time with mean to get the higher mean value. Like, mean for one year is 10%, mean for 2 years will be 20%, mean for 6 months will be 10 into 0.5, which is equal to 5%. Okay, but standard deviation is not proportional to time. In fact, variance is proportional to time. Okay, standard deviation is proportional to square root of time. Okay, I'm just writing that. Okay, mean is proportional to time. Okay, let's say I make it small t. Okay, variance is proportional to time. Standard deviation is proportional to square root of time. Okay, I'm using this notation as proportional. Okay, I mean, this is just my own notation because I don't want to write is proportional. Okay, standard deviation is proportional to square root of time. What does this mean? Okay, this means that, let's say variance, if standard deviation is 24%, variance is going to be 24% the whole square, right? I'm just calculating what this is. So this is equal to 576% square. Agreed? Variance is 576% square per annum. Okay, now if I ask you to calculate variance for 3 months, you can do 576% square into 0.25, which is equal to 144% square. Okay, this is nothing but 0.25 because 3 by 12. Agreed? Okay, standard deviation. Now, if I ask you to calculate the standard deviation for 3 months, okay, one way of doing it would be taking square root of 144%, right? Because variance for 3 months is 144% square. So standard deviation for 3 months should be square root of variance, right? So square root of variance is 144% is nothing but 12% for 3 months. Okay. An alternative way would be, or you can take the standard deviation that we had got over there was 24% that we started off with, was 24% per annum. Okay, you should not multiply it with 0.25, you should multiply it with square root of 0.25. That is what I mean, that is what I meant when I said standard deviation is proportional to square root of time. Okay, this is square root of t or square root of 3 by 12, right? Okay, and square root of 0.25 is 0.5. So 24% into 0.5 is nothing but 12% for 3 months. Okay, so one way of doing it could be calculate variance the way, however, you calculated mean as 10% for 1 year means 5% for 6 months. Okay, similarly, you can do that for variance. You cannot do that for standard deviation. If you want to bring standard deviation in terms of 3 months time period, you cannot multiply it by 3 by 12. You have to multiply it by square root of 3 by 12. Okay, variance is proportional to time and standard deviation is proportional to square root of time. So these were the two concepts that I actually wanted to cover. Number one, volatility is captured in a single period binomial. And obviously, if it's captured in a single period binomial, it is captured in 2-period binomial also. Well, it is captured through U and D. The second thing that I wanted to say was standard deviation is not proportional to time. Standard deviation is proportional to square root of time. Okay. So if somebody says 100% is the standard deviation for 1 year, hypothetically, okay, what is the standard deviation? Now, let us plot the numbers, right? SD is equal to 100% per annum. Hypothetically, I don't know whose SD will be 100% per annum. Okay, now I'm asking you to calculate SD for 6 months and SD for 1 month. Okay, SD for 6 months will be 100% into square root of 6 by 12. And over here SD for 1 month will be 100% into square root of 1 by 12. Okay. Generally, what we would have thought was SD for 1 year is 100%, SD for 1 month is 100 into 1 by 12. No, SD for 1 month is 100 into square root of 1 by 12. Okay. Had this been variance, had this been 100% square variance, then you could have done just into 6 by 12 and into 1 by 12 for variance of 6 months and variance of 3 months. Okay. So 100 into, so the first answer will basically be 70.71%. And the second answer is 28.87%. Okay. All right. Now let's get into the formula for U and D. Okay. Finally, U is equal to E raised to the power sigma root T. Okay. That delta T is actually nothing but sigma root T. Okay. So where T is the maturity of the option contract. In our case, the maturity of the option contract was 6 by 12. That please ignore that delta T. I mean, basically I couldn't insert a formula, insert this symbol in PowerPoint presentation. So I copied it from somewhere, and that author actually uses this notation. Okay. This notation delta T refers to normal T itself. Okay. So U is equal to E power sigma root T, and D is equal to E power minus sigma root T. And this is also equal to 1 by U. If you remember, right in the beginning, I said D should be equal to 1 by U. Okay. So that is how it is. I will just explain this formula as well. Okay. Let's come to the normal file. Okay. The meaning of volatility over here in general, in options, is basically meaning how much can the stock price move today, move from today's share price by the maturity of option contract. Okay, so we have a single period binomial model where the current share price is 50. Okay, we want to calculate what the option price can be over here and over here. Okay, volatility is nothing but how much an option price can move by t equal to 6, because t equal to 6 months was our was the option maturity in our example. Okay, volatility is like how much can the option share price or the share price move by in 6 months. Okay, if the volatility is, let's say 20%, hypothetically 20% per annum. Okay, it's 20% per annum, and this volatility is nothing but volatility of stock returns. Okay, it's basically calculated as normal SD as what you would have done earlier. It is summation x minus x bar the whole square divided by n or n minus 1. Okay, so it is nothing but you take the stock returns and you calculate the SD of those returns. That SD of those returns is nothing but 20% per annum. Okay, the way this 20% basically needs to be interpreted is how much can the stock price move from today by the end of 6 months. Okay, now 20% per annum means SD for 6 months. Now I'm calculating how much the stock price can move for 6 months. Okay, so I need the volatility for 6 months, not 1 year, because this is volatility for 1 year. Now calculating the volatility for 6 months, it is basically 20% into square root of 6 by 12, just like how we did earlier. 20% into square root of 0.5, that equals, it is about 14.14%. Agreed? It is 14.14%. Okay, so one way of looking at it is the share price from here can either go up by 14.14 or it can fall down by 14.14%. Okay, so the share price can only change once in a binomial model. Okay, and what could be the potential share prices? The share price can increase from the current share price to either upside 14.14% or downside 14.14%. Okay, and if I'm, so the share price at the upper node, okay, upper node will be 50 into 1 plus 14.14 percentage. Okay, this is nothing but 50 into 1.1414. Okay, is equal to some number. Okay, on the downside, the share price will be 50 into 1 minus 14.14 percentage is equal to 50 into, I don't know what this is, 1 second, into 0.8586 percentage into 0.8586. Okay, so what I'm doing over here is I am basically assuming that the return could be either positive 14.14 percentage or negative 14.14 percentage. That is how volatility is being interpreted. The share price can either increase by 14.14. Okay, so the share price in future at the upper node will be 50 into 1 plus 14.14. Okay, this basically means that I'm assuming that the share will give a return of plus 14.14 percentage. Okay, and on the downside, I'm saying that the share can give a negative return of 14.14 percentage, which means the share price will fall by 50 into 8.8 into 0.8586, which will ultimately give you a negative return of 14.14 percentage. Okay, and if you see, there is going to be a gap over here between of 28 percentage. Okay, because this is going to represent minus 14 percentage, this will represent plus 14 percentage. Okay, there will be a gap of 28 percentage between the bottom node and upper node, which is nothing but 2 times standard deviation. Okay, so the gap between the bottom node and the upper node is 2 times standard deviation. This 2 times standard deviation has a significance, but unfortunately, I'm not in a position to explain that significance to you because there are a lot of terms that we have not yet discussed, which we will be discussing as part of Black-Scholes model. Okay, but for now, just I mean, without that also, it is fine. I mean, without understanding that also, it's completely fine. So just remember that there's a gap of 2 standard deviations between the upper node and the bottom node. Okay, and if you actually see implicitly in our example, I have assumed that the standard deviation in the example that we have initially started off with, I assumed that the standard deviation is 10% for 6 months, and that is the reason I actually moved it from 50 to 55 and from 55 to 45. Okay, and there is a gap of 2 standard deviations in between. Okay, 2 standard deviations basically is nothing but one standard deviation is 50 into 10 percentage, which is $5, right? 50 into 10 percentage is one standard deviation. There is a gap of $10, which is nothing but 2 standard deviations. Okay, one standard deviation is equal to 50, which is the current spot price, S0 or S into 10 percentage, which is over here S into sigma. Okay, this is sigma standard deviation, which is $5, right? Okay, there's a gap of $10, which means 2 into 5. All right, so there's a gap of 2 SD. All right, so I had implicitly actually assumed that the volatility of returns in our example was 10%. Okay, now I've told you all this, but I've still not told you what that e power sigma root t and e power minus sigma root t is. Okay, over here, if you actually see, what we did was we did 1 plus 14.14 percentage and 1 minus 14.14 percentage. Okay, now the formula over here, which has e power sigma root t, what this assumes is this 14.14 percentage. What I mean, we started off actually with 20 percentage per annum, and then we came to 14.14 percentage. Okay, what that formula assumes is it is actually being done on a continuous basis. Okay, I did into square root of 0.5, right? I basically over here I've done as square root of 0.5. Okay, but this is actually discrete compounding, or simple compounding, right? I mean, you would have, even if you have not learned, that's fine. I will probably take a separate lecture for it, or give you the link of where I believe that there is an online course, where online video where you're taught about different types of compounding. You can have, like compounding on a per annum basis. You can have compounding on a per annum, or you can have a semi-annual compounding, or you can have a quarterly compounding, or you can have continuous compounding. Okay, this formula assumes continuous compounding. Okay, so when you actually do e power sigma root t, Okay, where sigma on a per annum basis, standard deviation on a per annum basis is 20% per annum. Okay, and if you calculate e power 0.2, because sigma is 0.2 into square root of t. Square root of t in our case is nothing but we were trying to calculate the volatility for 6 months. Okay, we were trying to calculate the volatility for 6 months. Okay, if I do square root of 20 into, I mean, e power 0.2 into square root of 0.5, I get e power the same as what we got above, e power 0.1414. Okay. Now for those who are doing CFA and FRM, you can straight away use your second e power x formula to get what this e power 0.1414 is. For the CA students, I mean, you are generally given a table. You're not given you're generally given basically the formula for e power any number as well. Sorry, but I can show it to you in an Excel file too. If I use the function exponential 0.1414, the answer is 1.1519. It is basically 1.1519. Okay, if you actually look at this, this has given you what you were actually calculating as part of the bracket. 1 plus 14.14 percentage, what you were actually calculating as 1, which is today's share price, plus a return of 14.14 percentage. That e power x formula has already given you as 1.1519. Okay. So this one here, of course, the answer is not the same, because over here you're doing it on a continuous basis, whereas over there you were actually doing it on a discrete basis. Okay, you have straight away over there just multiplied it by square root of 0.5 and you got an answer of 14.14 percentage. But E over here basically makes you do it on a continuous basis, and what you get is 1 plus the return itself. Okay, so the return is 15.19 percentage plus your original principal of 1. Therefore, it is 1.1519. And if you want to calculate the share price on the upside, it will be 50. And straight away, it will be 50 into 1.1519. Okay, which is nothing but about 57.60. Okay, therefore, the share price on the upper node is actually S into e power sigma root t. Okay, where e power sigma root t is actually nothing but u. Okay, in our example, we had taken u to be 1.1. Okay, and then we calculated the upper side to be s into u. Instead, it is s into u, where u is e power sigma root t. Similarly, we can also have a fall in share price of about 14%, right? I mean, we can there could be a fall in the share price of 14.14%. Therefore, if you actually substitute, I think I am okay, fine, I'll do it at the bottom side. Okay, it could also be e power minus 0.1414, where I'm saying that the share price can fall by 14.1414. Okay, and if you do the second e power x of minus 0.1414, the answer is basically one second. It is 0.8681. Okay, and this is actually giving you nothing but 1 minus 14.14 percentage. What you got is 0.8586. That the equivalent of that is 0.8681, and you have got a different number from the above because you're again doing it on a continuous basis over here. Okay, so this is 0.8681 on the bottom side. So on the down node, you will have 50 into 0.8681, which is equal to about 43.41. And this is nothing but S into e power minus sigma root t. Okay, and if why is 1 second, guys? Okay, now basically, if you actually remember at least your 8th class or 6th class mathematics, I don't know, e power minus 0.1414, or let's say I will not take the numbers, apologies. Okay, I said e power minus sigma root t is actually nothing but 1 by e power sigma root t. Okay, and 1 by e power sigma root t is nothing but 1 by u. Okay, so D is equal to e power minus sigma root T. E power minus sigma root T can be written as 1 by e power sigma root T, and that is equal to 1 by U. Okay, so this is how basically that formula has come actually. All right. Now, if I come back to the original PowerPoint presentation and we quickly go through this, volatility here needs to be understood as how much can a stock price move from today's share price by the end of the option contract. Okay, today's share price is 50. The end of the option contract is 6 months. How much can the share price go? It either up or down from today's share price. Okay, instead of using 1 plus or minus sigma, which means basically initially, if you saw in our example, we had basically used 1 plus or minus sigma, where sigma, we used 1 plus 14.14 percentage and 1 minus 14.14 percentage. Instead of using that, what this formula is doing is, it is using continuous compounding to arrive at the above formula. Okay, so e power sigma root T is actually another form of 1 plus sigma, and e power minus sigma root T is another formula for 1 minus standard deviation. Okay, that e power basically takes care of 1 plus also. All right, so this is basically doing using continuous compounding. All right, so maybe I will make a separate lecture for continuous compounding also. Okay, now even if this assumption is not satisfied, which means over here we are saying that D should be equal to 1 by U. Okay, but even if this assumption is not satisfied, we can go ahead with solving sums. Heavens are not going to fall. The only thing is, all softwares or all computers, they always implicitly assume that D is equal to 1 by U. Okay, there is, I mean, you cannot have different values for U and different values for D. D should always be equal to 1 by U, and that is because of the logic that we actually proved, right? I mean, because e power plus sigma root T basically means how much the share price can go on the upside, and that same sigma root T is what we are saying as how much can the share price move on the downside. Okay, so e power and e power minus sigma root T is nothing but 1 by e power sigma root T, which is nothing but 1 by U. Okay, so if you use continuous compounding especially, then e power minus sigma root T has to be equal to 1 by e power sigma root T. However, if you don't use continuous compounding and use discrete compounding as what you used over here and here, okay, obviously 0.8586 is not going to be equal to 1 by 1.1414. Okay, 0.8586 will not be equal to 1 divided by 1.1414. If you remember, even in our example, we had taken 1.1 and 0.9. Okay, D as 0.9 and U as 1.1. D 0.9 was not equal to 1 divided by 1.1. Okay, so even if you do not make that assumption, you can proceed. Heavens are not going to fall. It's only that you cannot match your answer with any of the softwares that are available in the market, because all softwares, they give you the answer in such a way that U is equal to 1 by D, or D is equal to 1 by U. Okay. Okay, so that's it for this lecture. I think like finally I've given you the answer for what U means and what D means. And I've also shown you that volatility is captured in the single period binomial model. In the next session, we will be going to 2-period binomial model. Okay, and we will start off with risk neutral approach within the 2-period binomial model. All right, thank you guys.